Welcome to the Good Divorce Show, where we can help you learn how to navigate the journey of divorce with less conflict, less debt, and equip you not to just get divorced, but also learn how to be divorced. Your host, Certified Divorce Coach Karen McNenny, shares her wealth of knowledge, gets advice from other relationship experts, and interviews couples who learn how to have a good divorce, so you can too. Now here's your host, Karen.
Hello, listeners. Thanks for joining me today. I am Karen McNenny, your Good Divorce Coach. And here on the Good Divorce Show, we're chatting again with someone who's become a regular on the program, Rosetta Barker, who's not only gone through her own good divorce, but continues to help others find their path through something less destructive with less debt. Welcome back to the program, Rosetta.
Thank you, Karen. Always fun.
I mentioned in the introduction that you came on to the show to share your own divorce story, which absolutely is one of the great good divorce stories. I encourage our listeners to go back and listen to it. So you come with a relevant perspective, but you also come with a litany of relevant skill set. Can you just one more time give us the breakdown of all the things that you touch and have knowledge about that ultimately are connected to a divorce experience?
Absolutely. Well, I'm an investment advisor. I have a securities brokerage firm, and I've been in that business for close to 30 years. And I'm a certified divorce financial analyst, which is the person who helps put together the whole settlement, all the financials. I'm a licensed real estate agent here in Texas. I'm a licensed mortgage broker as well. And I'm a certified divorce lending professional as it relates to, just divorce topics. And I'm a mediator. I'm a civil and family child custody mediator. So it's just sort of all these tools kind of come to, I'm also a divorce coach, of course.
So today I want to dive into something that most of us normals running around don't fully understand, which is just investments, where money might be sitting, how it's taxed, what gets taxed on the outside, how we should divide things up inside the divorce world. So let's start with some categories of where people might have money sitting and give us a quick little description of the Roth IRA versus the IRA versus the annuities versus my retirement with my workplace versus the inheritance that I got 10 years, like all the places that money sits and what we need to know about it as we consider our division of assets.
Well, you don't ask a small question, do you? Well, it's true. Every divorce, has a bucket of assets, and it's important to be able to categorize them and put them in their proper place, if you like. The simplest would be to categorize after tax and pre-tax. And what that means is after tax is any bucket of money that has already paid tax on it. So for example, if you have a savings account and that came in from your income, you've already paid tax on that. Your checking account, most of that we understand is after-tax money. The pre-tax money is money that has gone to an account typically from your paycheck before you see it. And that can be a 401k, for example, a 403b, any kind of ERISA plan, work plan. They usually just take that out of your paycheck before you even see it. That is number one clue that that's a pre-tax account, meaning it has not paid taxes yet. And that's went
into a bucket. The government has taken their percentage. It's sitting there. Okay.
And it's growing, what we say, tax deferred. So, and that's a great advantage because your money is allowed to grow and be invested and all that before having to pay any tax. But as soon as you take it out, you will be taxed for the full amount.
Right. Because it's not tax-free, it's tax deferred.
Yes.
Yes.
Very important. Okay. And the IRS always wants their money at some point. Okay. So when you're and the IRAs are also tax deferred. Those IRAs are usually funded with voluntary contributions. And then you can deduct them from your tax. So if you write a check for $6,500, $7,500 for the year or something to put into your IRA, when you go file your taxes, you're going to tell your tax person, hey, by the way, I contributed my max amount allowed to my IRA, and you don't get taxed on that. So that too gets that is also tax deferred. So it means that all the money that's in that account has never been taxed.
Okay.
So that's important to understand. Okay. Roth IRAs, which is another category of IRA, is funded with after-tax money. And there are some rules with Roth IRAs. There are some limitations of how much you can put in. And honestly, right now on the spot, I don't know exactly what that dollar amount is, but there's for, depending if you're married, if you're single, and there are requirements where you can't take any distributions for 5 years. You have to be 59 and a half. Let's backtrack. Also with IRAs, you have to be 59 and a half to be able to take out money. With the IRAs, you will be paying tax, but you don't pay penalty. With the Roth IRA, you don't pay the tax, but you would pay the penalty if you do it before 59 and a half. And if you haven't met all these other little requirements. So Roth IRAs would be something that you would want to speak to your financial advisor about the desirability of having one. How does it benefit you? But anyway, but getting back to the divorce, what's important here is, okay, we have all these buckets of money. How is this to be treated? So after tax money, let's just say one spouse is going to keep $100,000 of equity from the house. And so they're going to offset it with $100,000 from a retirement account, 401k, let's just say.
Right. Well, and just to interject this offset, I always think of the asset game as like a teeter-totter. It is. One side goes up and one down, and what we're trying to do is
even it out.
Even it out.
Right.
Right. So my spouse gets $1,000 equity in the house that they're keeping, but I need $1,000 to come from somewhere. And the tax treatment of that $1,000 actually matters. But most of us don't realize that there's different treatments.
Yes, because when you see it on a spreadsheet, you think, oh, well, okay, 100,000 over here, and then we'll just put from the retirement 100,000 over there. But no, because that 100,000 is less than 100,000 because it hasn't been taxed yet. The house money is after tax.
Yeah. And
so
actually
that would not be fair.
And probably growing because it's in an asset that is going to continue to grow in value.
Well, that part wouldn't matter.
That doesn't matter.
Because because you're taking a snapshot in this moment of time when you're getting divorced. What are all the values here?
Okay.
So when you start looking and say, well, I'll keep 100 from the house and then I'll give you 100 from my retirement. No, it's more from the retirement. You got to do the math and give it a pre-tax amount so that the person after they pay taxes is going to get 100,000.
And what typically is like the percentage or what would that be?
Count on 20% tax. That's 20% usually withhold. So you would take the money, 100,000, and divide it by 0.8, and you're going to get that amount. What that amount should be,
which is in that case.
I'm sorry, I can't do that in my head.
80,000 instead of 100,000. If it's
divide by 0.8 is $125,000.
Okay, so that's what we would need in order to make the teeter-totter equal 100,000, 100,000. So I actually need to move 125,000 out of my retirement account to my spouse.
That's right.
Because it hasn't been taxed yet. Now what kind of an account would that apply to?
That would apply to any non-taxed. No, Roth has already been taxed.
Okay.
So that's an IRA, a 401k, any retirement fund that gets funded pre-tax.
Okay.
So those are the little things, that when you're going through, I didn't even think of that. Well, sure, because that's not going to be fair, right? That's not equitable.
Yeah.
Apart from, so we have these different accounts. There are 529s, for example. Some people come with 529s. 529s means they're constructed where the parent is a custodian for that money, and it's for the child until the child turns 18. I think in most cases, those 529s are considered the child's money, even though the custodian has control over it. There are, I don't know exactly what the rules are if a custodian decides to take out money from the 529, but there's all kinds of penalties and stuff. So it's usually considered the child's money. As soon as they turn 18, it's theirs. It's not, now, you can say, okay, well, you have 30,000 in this 529, so let's fund another one where I'm the custodian. Right? And so now you have two 529s with her, or if you have another child, there's ways to kind of work through that a little bit, but I wouldn't get too overheated about it, is what I'm trying to get at. I think that's a small thing to be able to figure out.
Okay.
HSAs are another one, the health savings accounts. Those can't be split. So many couples have HSA accounts, and that's where they're paying their medical, right, from. But when they split, can't. So you might as well just open your own, the other person opens their own HSA and just fund it with marital money and be done with it to make it fair. Trying to think what other annuities can be split. They do require court orders. So let's talk about that too for a second.
Yes, please.
Because this is important. So in your divorce decree, when you're looking at a spreadsheet of your banking accounts or savings accounts, all that good jazz, the couple can move money around, right, without any problem, whatever their agreement is. If it's 50-50, 60-40, a dollar amount, whatever it is. An IRA, for example, can only be in the name of one person. It's never a joint account. So an IRA cannot be transferred to the spouse if it isn't spelled out in the decree. It has to be incident to divorce. So at a brokerage firm, and for example, our brokerage firm, we clear through Schwab. And when I get somebody saying, oh, we want to move, we're getting a divorce, I need to move some of this IRA, I have to ask for the divorce decree. And of course there are other forms, but basically the divorce decree is what's going to determine, the moving over, and you can't change the amount. So typically we do percentages, because a brokerage account in an IRA that's invested, it's changing value every minute we're talking. So you just take that percentage, 50-50, 60-40, whatever it is that the couple has decided, that's what's going to be transferred to the other person in an IRA. And the same rules will apply in their IRA. They have to wait till they're 59 and a half to be able to take money out penalty free. If they do take out before, they'll pay penalty and the taxes, of course. You always pay the taxes, but it's the penalty part. Okay, those are IRAs.
Can I
don't need any other kind of, yep, absolutely.
I'm going to redirect on penalties and how divorce has sort of their own rules when we're moving things in and out of an account that typically would be penalized, but because of a divorce, we have a quadro. You want to talk a little bit about?
Yeah, that's where I was headed. So
that's
IRAs
where you're headed.
Do not, yeah.
Great.
IRAs don't need quadros.
Yes.
You just need the divorce decree.
Tell us what the quadro is. So IRAs, divorce decree, we move the percentage. Quadro stands for
dollar amount. Quadro is Qualified Domestic Relations Order. It is a court order. It is written up by an attorney, not a divorce financial analyst or anything like that. It is a legal document. And quadros are needed for any kind of work plan, what they call them ERISA plans, employment, retirement, investment accounts that companies, put money into that are coming out of your paycheck, all that kind of stuff. So those are 401ks, 403bs. There are a bunch of different ones. There must be a court order. And the tricky part about 401ks that you have to be really careful about, and attorneys know what they're doing. So this is important to know. The 401ks, for example, have a plan administrator within the company. There's somebody that is managing these 401ks. And every company's plan administrator has different rules as to what they need to be able to accept that quadro and act on it. There are cases where quadros aren't done properly. The divorce goes through, the quadro is submitted, and the plan administrator says, sorry, no can do. What?
Dear.
So, yes. So, it's either an attorney is doing it, or there are services, like in Houston, we have a company called Quadro Services out in the Woodlands, and I'll always turn to them if we need. It takes it's a specialty of kind, sort of. Not all attorneys will do it. The attorneys will also outsource it, right? Because there's just too much liability in getting it wrong. So it's just nice to know. It's nothing to be afraid of. It's just important to know the different moving parts. So once the plan administrator receives the quadro and it's been accepted, they create an alternate payee, which is the spouse that's going to receive their share.
Okay.
And then the spouse can do with that money what they want to do. They have a couple of choices. They can transfer it into an IRA, and this is important because this is a non-taxable event. Going from a 401k to your own IRA, you don't pay taxes on that money because it's still staying in that pre-tax mode.
Okay.
The other choice, and this is an interesting one because it's only in the case of a divorce, the spouse can have an option to take either all or part in cash, penalty-free, not tax-free.
Of the divorce.
Correct. And that's why a quadro is so important, because the quadro not only tells the plan administrator, the company, how that needs to be distributed, it is giving this penalty-free opportunity to the spouse, the one receiving it. So sometimes they're hard on cash. They need it because they got to move out. They got to put a down payment on a house and whatever. And they didn't know that they could do that. Of course, they're going to pay tax on it, but they're not going to pay penalty.
Right.
So that's a nice little option. Quadros are needed for annuities as well. An annuity, I'm not sure exactly how that's split, but I'm assuming it's the same thing. It's an alternate account in the spouse's name, and that's divvied up. So a quadros are for things that are not IRAs.
Okay. That's a good clarification for not IRAs. Now, let's say that I finished my divorce. Money has come to me through household assets. The husband bought the boat out. I'm sitting with cash. I'm sitting with investments. What do I do with it? More importantly, what do I need to take into consideration as I decide that? And how does it vary depending on my age and age of children? So that's another big question for you, Mercedes. What do I do with my lump money so it serves me? And is it kind of stage of life dependent?
Absolutely, it is. And it's goal dependent. It's risk dependent. I mean, this would now be something that is outside of the CDFA work, but since I'm an investment advisor anyway, I end up incorporating it because it matters.
Yes.
It really does. And I'll give you a really quick case I'm doing now with somebody. I am an advocate for one. She stands to keep about $1 million. She's 62, has no income potential. The husband does. He'll be keeping about the same amount of money. And his argument is she doesn't need anything more because her investments can earn 7% a year. And that's all she needs. So if it's $1 million, it's $70,000 a year. Well, no, because what is that this is why it's important. Investments are important when you're planning your divorce and how you're going to live. Where are you getting that extra income? And especially when we're talking about gray divorces, where going to work at 62 is just not easy. The
Yeah.
job, unless you have a real career going for you, you're looking at, probably minimum wage, and that's not enough. And so how do I make my $1 million in this particular case work for me where I don't outlive it? And when the case, and this is a contested divorce, so it is a little different, but when the argument comes back saying, well, she can make 7% on it, that's 70,000 a year, that's enough, that's all she needs. Well, let's break it down. Really? The 7%, you need to study how much money is being generated that you can take out without disrupting the portfolio. You have dividends and interest, and you have growth. Let's just break it down to those three things. You have growth of the assets, and you have dividends and interest. If your money is making everything you need in dividends and interest, then your portfolio can withstand the growth and the ups and downs and going back down and going back, because you're not really touching it. But if your growth, like in this particular case, and this is what I'm going to be arguing this week, if your portfolio, that 7%, dividend and interest is only 2% of it, how do you handle the 5% that you need? What do you need to do to get your hands on that money? It's not coming from dividends and interest. You have to sell shares. Uh-oh. If you have to sell shares, what's happening to the portfolio?
It's also shrinking now. Yeah.
And when the portfolio shrinks and shares are sold every year, your dividends and interest also come down because they're based off of the number of shares you have. So this is a misconception that I run into all the time. Oh, I just put it in 7%. The portfolio is going to grow. No. You got to tap into it. And what do you do on down years? Now let's do a hypothetical. Let's do the math real quick. You have $1 million. Year one, the market's down 20%. You have unrealized losses of how much? Your portfolio is worth $800,000. That's 20% of $1 million is 200,000. Now your portfolio is worth 800,000. But hang on, you need to take another 5%. Remember, because you needed money above the dividend and interest. So now your 800,000 has gone down to 750. So you're starting year two with 750, not $1 million. And that's just year one. At 62, you may have 20, 25, 30 years to go. You're not going to make it.
Yeah.
Well, I can't say that. You may make it, but to go from 750 back up to $1 million when you're still needing to take money out, what does the market need to do? It needs to be up 50, 60% in a year just to break even. These are the numbers that really people aren't that aware of and need to, and the brokerage firms, because that too, I was trained that way. You do the hypothetical planning.
Yeah.
And you run a Monte Carlo type thing, and out of 1,000 possible outcomes, the chances of you, making it and not using your money is X%. Well, that's great. But in the real world, I could paint a real simple picture that that's not the case. And the client needs to know this. It's not to scare anybody, but we need to be a little realistic of what can happen to your money. And it only takes a couple of bad years to change your whole picture very quickly.
Right.
I ran a 10-year for this client where only 2 years were down. All the rest were up. And taking out 70,000 a year, she went from 1 million to 193,000 in 10 years.
Oh, wow.
So it's just sort of, be careful. There's more to this. Yeah.
And again, I'm going to highlight the wonders of the lawyer who's fighting for you is going to get your $1 million and say, look what we did. Good luck. Without forecasting what your financial professional, more specifically your certified financial analyst, which is what Mercedes brings to the table, that you can't just blindly walk into
Mm-mm.
these financial conversations without looking at the long echo of
Absolutely.
the decree itself. And most of
Absolutely.
us, myself included, have no idea how this stuff works.
And there's no reason for anybody to know how this
Right.
works. That's why, I mean, that's why you ask professionals. But I'm just saying that when these Monte Carlo pictures are really great tools. Don't get me wrong, they are. And they're also asset gathering tools. I don't mean to put a thing, but that's how I was trained. And one of the reasons why I ended up going independent, because I couldn't stand thinking that I'm doing these things to try to get more assets to come to the company rather than actually trying to help. So it's important that a client understands it. And when you're in a battle for divorce and everybody's throwing these numbers around like, oh yeah, no, she would make 7%. That's good enough. No, yeah. Let's not talk in those numbers. Let's be a little more realistic and a little bit more careful about how we go and how we can turn this around and help out, right? So investments are important when you're looking at the big picture. Sometimes people just don't have the assets. Unfortunately, that's just the reality. And they are going to depend on Social Security, which is never enough.
Nor are you going to guarantee anymore. It feels
I know. Isn't that a sad state
again,
of affairs? I know.
Speaking in the middle of 2024 right now, and who knows what the future will bring.
Nobody knows.
That kind of government funding and support that we've been paying into our whole careers, but things really shifted in that climate.
And you have, sorry, go ahead.
No, I'm going to pivot. So you go ahead.
Social Security is an important thing too. When you have a couple where one spouse was the one who worked and the other one that didn't, the one who didn't is going to be entitled to 50% of the other spouse's Social Security. Now, the other spouse isn't losing that money. It's just that the IRS will honor it. But think about that for a minute. If I don't know what your average Social Security number amount, but let's just, for just as an example, let's say your spouse is going to get $3,000 a month. They're talking about you getting $1,500 a month. That's fixed. I mean, we all know that $1,500 a month is not enough to live on.
No,
it just isn't. And if you kept the house and you don't have a mortgage on it, that's great. But you got taxes on it. That $1,500 is gone the first day of the month between house insurance, between this. So what are you going to live on is a painful conversation sometimes, and especially in gray divorces. I mean, the gray divorces that have money is great. I mean, that's a much easier situation, right? They're all willing and wanting, and they can throw money around and be comfortable. But for those that don't, this is a very difficult situation, and there is no magic wand.
Yeah. And I'll add, it is my understanding that 50% of the spouse's Social Security is only if you've been married 10 years and you don't.
Yes.
So, in speaking to those that are maybe not 30 years married and getting divorced, but 9.5 years married and getting divorced.
Stay married for another 6 months is what I would say.
That's right. Yeah. And
suck it up and stay married for another.
Went through this with a couple, and their decree was done and they're ready to file. Wife is like, I would like to wait. It was like 4 or 5 months. It wasn't years.
Yeah.
Just our wedding anniversary to receive that. Now, husband was like, I want to do it now, because then that becomes a qualifying event for me to change my insurance. And he financially needed the support so he could go to his insurance company through his employer and change things around, because
he could have done that afterwards.
Qualifying life event. He wanted to do it as soon as possible because there was certain treatment he was getting that was going to be covered better by switching around his insurance. So that, that was the goal
terrible
of the two of them. And they were a really amicable couple and on board with everything. But now there was this 6-month little wrinkle where, again, that's another thing that can shift around in the face of
Yeah,
divorce.
it impacts the rest of your life.
That's right. Now,
You know,
they were very young, and wife anticipated, I'm probably going to remarry.
oh, well,
And
okay.
so
Maybe it's not
I'm
so bad.
willing to file today so husband can change up his insurance where the kids are also covered, right? There was a number of like
Yeah,
cascading, but again, when two
yeah,
people are at the end of a hallway going through a mediation, or lawyers are the only one having conversations,
yep,
I was able to sit at the table, not once, but multiple times with these two parents and say, well, okay, well, we've got this over here and this over here, and where can we give and take, and where's the long-term effect? And oh, the kids are covered there, so maybe shifting that. And well, you're, 28, chances are you'll remarry. Like, what,
yep.
so they came to their own solution because they were
That's
given the
good.
opportunity to talk about it with
Right.
each other. And they're the ones who have to live with the
That's correct.
consequences of that decision,
Absolutely.
not
Yep.
the
Yep.
lawyer or me, quite frankly, or anyone else.
Yep.
So I always believe that best results come when the couple gets to design their divorce and be the leader of their decision making. Not always
I would,
possible,
I know,
but that's the
but I
movement we're
agree.
a part of here in the Good
I
Divorce
agree.
experience.
Hmm.
Yeah.
Yep. And even bad divorces can do it
Uh-huh.
if, I mean, I mean, I've dealt with difficult divorces.
Mhm.
It doesn't have to necessarily go contested, or it could just be contested on one little part where they just have to lean on attorneys and maybe the judge, but they
Right.
can get most of it done.
And some
Um,
people might be great with money and assets, and it's really the parenting plan and
yeah.
where the kids are going to live and the summer schedule and what school,
Oh,
right?
yes.
That might be where the big debate is. And that's why all of us should be able to design our own divorce, because we're all a unique family with our own
Well, as a
circumstances.
CDFA, I do my very best to make sure that the one who doesn't understand it as well has time with me.
Yes.
I go all out to explain and to re-explain and explain it, because it isn't easy when you're not living in that world. It's just too much information, and just everything is so confusing, and
Yeah.
you're again, you're with that brain fog.
Anyway,
But
the
they
grief.
have the right to know.
Yeah. Yeah. Other things that should be considered according to age. We've just talked about a few of those things, but whether I'm 30 and moving into my career, or I'm 65 and closing out my career, what kind of investment considerations should I take into account?
Well, and that's a great question, because that's the one that always stumps all of us. So right now, with high interest rates, fixed income is a pretty good place to be, because you can put money at 5%, or more if it's on shorter term. But if you do a 2-3 year, you're out probably about 5%, or just under for 5 years. And you're getting interest rates that you couldn't get before. We've talked before about low interest rates and how wonderful they are when you're buying a home, but they're terrible when you're trying to make money on your money. So, and what happens when in low interest rate environment, you have to take risks, because the only place you can get it is with stocks or some combination of higher risk, right? When you're talking CDs, that's
Yeah.
safe money. You're going to get all of it back, and you're going to get your interest. So right now, when dealing with some of these couples, fixed income comes into play. But here, I mean, in a bigger way. But here's the downside to it: high interest rate. We also know we're in high inflation rate, environment. So just because you're making 5%, you're not going to beat inflation year after year after year.
Mm-hmm.
And of course, interest rates fluctuate. So likely we're headed back down at some point here in a few years, or maybe as early as next year they start. I don't think it'll be this year, but next year. Uh, and as interest rates go down, the more risk you need to take to keep your money growing.
Mm-hmm.
Otherwise, again, you're in that same. So what do you do? Gosh, every case is different. But with these interest rates, I would try to take advantage, at least in the shorter term, you know, 1 to 5 years, let's say, just kind of lock in, if they have money to do that, lock in an amount that you know you're going to get, that you can count on. But you're still going to need to have some exposure to the market. And that means everything. That means crashes. That means, you just have to go with the flow and hope that, things do come out okay in the end. But the older you get, the less time you have to be able to, live through those types of crises. I mean, in the 2008 crisis, which I was with, I'm sorry, the girl thing going. In the 2008 crisis, I was with Wells Fargo. Well, actually, I was with Wachovia Securities. And in all of that turmoil, we had clients, reaching retirement age, and nobody issued a sell, right? You need to sell and get out because we're headed for a big crisis. No, it was stay in, because that's how they train you. Stay in, and ride it out. And ultimately they were right. But they're right in that it only it took 10 years to see that money back up to where you were, sort of, somewhere in there. So what do you do with a 65-year-old who was ready to retire and now can't? So those are the risks of not. Now, if you're a 20-year-old, a 30-year-old, a 40-year-old, that's fine. Just ride it out. Past performance is never future performance, but we do know that over the long haul, market goes up. Okay. Crashes are part of being in the stock market. You just kind of have to live with them. But when you are older, that is a real concern.
Absolutely.
And that's the balancing act.
Yeah. Well, as we come to the end of our segment today with Mercedes Barker, talking all things investment and the loopholes and the tax treatment, is there anything else that you would want our listeners to know as they consider not just what goes into the decree, but more importantly, what to do with that money thoughtfully after the divorce?
Yeah, I would always say you need planning. You need divorce planning. It isn't just the snapshot in time where you're dividing everything up. It's, how am I going to move forward? How am I going to live? Where am I going to be 10 years from now? Am I starting a new career? Do I have to work now? Do I, what? This is an important conversation to have when you're going through the divorce, because there might be things that you can still do. Sometimes there isn't, and you just have to start over, and that's not easy. The older you get, that's not easy. I would say planning. Take the big picture look and have a professional look at it that can walk you through it.
Yeah. Someone like Mercedes.
Someone like me, for example. Yes.
You can find her at your-divorce.com for all of those services. Always a pleasure to have you on the show, Mercedes.
Thank you, Karen. I always enjoy it.
Yeah. And I am your Good Divorce coach.
You are
Karen
indeed.
McNenny, here on the Good Divorce show, where we're always trying to show people a path towards less destruction, less drama, and less debt as you move into the next chapter. And remember, listeners, everything will be okay in the end. And if it's not okay, it's not the end.
Thanks for listening. Do you have questions or thoughts about this week's episode? Let us know by following the Good Divorce Coach on Facebook and Instagram at Good Divorce Coach, and leave a comment. And be sure to tune in every Monday at 10 a.m. Pacific, or listen anytime wherever you get your podcasts.